I think the common theme when I talk to people who have been in the space for a while is that the exuberance that was there in the past definitely does not exist anymore, right?
Right.
There is a healthy level of skepticism and expectation that things should work out and not everything should be crazy risky or too ambitious. But at the same time, there's also this sense of feeling that maybe overall the ecosystem has been a bit of a letdown.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave. Hey Mohan, good morning.
Morning.
I heard you went to pickleball this morning.
Yeah. I did. I decided to do like a 7 a.m. pickleball session.
Did you win?
No, I got trashed.
Are you like a newbie or you're just not?
I'm quite.
It's really
It's
good.
It's only my second time. But I went with my
Second
wife and Nick, one of my very old friends and
Yeah.
early investor at E27. He's been training for 6 months. My wife, she did really well.
She really well?
She did.
Are you sure you're not trying
She
to
doesn't
like...
have the best hand-eye coordination, but she really did well. She was like good. She was like really trying to learn hard. So maybe we're thinking of taking lessons now.
Oh, really?
Yeah.
That's good. That's such a good couple's day.
One day.
We should do it as well.
Yeah.
I mean, my wife is actually pretty good at pickleball.
Oh, really?
And I'm horrible. So my average
Perfect.
probably
Balances
similar
out.
to you
Yeah.
as well.
Did she take lessons?
No, she didn't take lessons, but she's always been very good at all these like badminton and all these games, such as that.
Try it next time.
Yeah. So we wanted to catch up because we've always had a lot of fun catching up. And I was like, you know what? We should just chat a little bit more regularly.
Yeah.
And take the opportunity. So I think I wanted to talk about 3 major components, right? So I think the first is like generally what we're seeing as investors in the space, but also we're both founders and executives. So I think that's one piece. And then 2, maybe a little bit of reflection of our own life journey and some of the attributes you see. So I guess the first big thing is when you look at the, say, startup and VC landscape today, and we've both been in the Southeast Asia tech landscape for 10 years.
Yeah.
So I think there's always that like before and after. What do you think has changed, like from your perspective?
Yeah, I had a good catch up with the client yesterday, and he was actually my client in the same space back in 2014, 15, when things were exciting, right? I think the common theme when I talk to people who have been in the space for a while is that the exuberance that was there in the past definitely does not exist anymore, right? There is a healthy level of skepticism and expectation that things should work out and not everything should be crazy risky or too ambitious. But at the same time, there's also this sense of feeling that maybe overall the ecosystem has been a bit of a letdown. A lot of things that were supposed to pan out have not. And then you've got the recent eFishery case that has really put a very black mark on Indonesian and even Southeast Asian founders and venture as a whole, right? I've heard the term sheets getting pulled out from other founders in Indonesia from overseas investors because of what happened there, right? And the sad thing is also the founder VC community is suffering, but then you've got the employees also getting a bit of a bad rap because there's a level of distrust around who's involved. So I think that really has led to just overall skepticism, negativity. Back then, when you see an idea, you meet a founder, right? There's always this mentality of, oh, wow, what if? Oh, this could be that. And now that has really shifted. And now I think it's a bit more skeptical. Oh, can it work? Will this make sense? How do you can this raise capital? On some level, it is healthy. And I think if you look at VC, if you look at the origins of VC, if you look at why the VC asset class exit, it's really to do big things, right? I think AI has helped in some sense. Maybe get back the shift to investing in big ideas, doing crazy things, but it's just not what it is.
Yeah, definitely. And I feel like there's been like 3 waves, right? I think the first wave where we both were there in the early days, back when it was like the first co-working spaces, Block 71. It was very much, I think that first wave was everybody was naive about startups. And so all of us were like watching The Social Network, the movie about Mark Zuckerberg and all the startup movies. And everyone's, wow, that's so cool. Copy the founder lifestyle in terms of wearing the clothes and focusing on work. It was all that optimism. And we were just saying, okay, what systems and models can we import from America or even China into kind of the Southeast Asia ecosystem? So I think there's like that huge optimism and naivete, right? I think the second wave was like the gold rush 2020 to 2022. I think that's when there was a lot of optimism and naivete by the VC. There's a lot of VCs that came in to bring a lot of money because of the zero interest rates. And I think the founders were more jaded by then because you've been working your ass off for like 5, 6, 7. But by that, of course, it was like a pumped, right? In that. And then the VCs were the one that were very naive. And it was a very hot job, high status job. And then now everything has reverted back to pre-pump, pre-wave. And now everyone's, okay, all the founders are like, yeah, it's equally as hard. But now we know that the return profile is much harder because it's hard to see the exits for Carousell or Ninja Van. There's so many companies that are like, were part of that first wave and now still pushing and growing. I feel like the reward profile has become, material. And now it's actually very hard, right? And then I think the VCs now are like, actually this is also a very hard space to be in as well.
See, the truth is this, okay, in the early days, when I say earlier, maybe 2010 to 2015, right? Everything was about Silicon Valley. And if you recall, Silicon Valley was in the era of no revenue, just growth at that point of time. So we all got sucked into that mindset and concept. Not to say it is wrong, but that concept really worked well in an environment where access to capital and having a very liquid exit market was prevalent. We did not have that here. Even when Carousell first started, I remember at Block 71, just a few guys there, no one deliberately questioned how's this going to make money, how are you going to raise capital, right? Everyone was just obsessed about the idea of, wow, if I have something to sell that I don't need at home, I can put it on a platform or a community and get it done. And that's where the original naive excitement over the what ifs was really strong in that era. And that's really because also the Silicon Valley folks that we were looking up to were all saying, look, build a great product, grow your community, don't worry about revenue first. That can come in later, right? To some level, it worked fine in the early days. But for Silicon Valley, once monetization starts, in most of their businesses, monetization ramps up extremely fast. That doesn't happen in this part of the world at all. It has taken Carousell a really long time just to get to 80 mil revenue around there. Many of the other well-known brands barely even break 50 to 100 range in this part of the world. So at least today, the need to get to monetization is a lot stronger, which I think is the right way. But a lot of ideas also need time to germinate. They need time to grow. The push for monetization too early can also create this unneeded pressure that startups have to basically do the easy thing or just look at what the customers want, make things simple and just execute, which is again not what the venture class is all about. So I think it's a fine and tricky balance. This region is learning how to manage that. But also the big wake-up call is both on the founder and investor side, which is at the end of the day, you have to return capital to LP. You have to find a way to exit. And I think there's a bit more pressure and effort now to do that, but not enough has done that over time in a structured way and working with the right entities to do that, right? So it's a bit challenging moving forward, right? What kind of whether more founders are going to come out and say, hey, look, it is actually worth my time and effort to build companies. It's challenging to see what kind of new funds are going to pop up. Because if every other fund is going to be just an AI fund, because that's just a hot topic, then when AI collapses, what's next? There needs to be funds that look at, hey, look, can there be good, sustainable, proper businesses in this region, which we don't see a lot of, right? In a way, Orwell's whole thesis of, hey, let's look for financially sustainable companies is trying to fix that, but we also know the challenges with finding companies like that, right? And then lastly, just fixing or tackling the exit scenario problem. I don't think there's any one entity, person, or organization that can fix that. It's not like the government can come up with an exit grant, right? But there has to be some level of maturity in the ecosystem with respect to scale of companies. Enough companies have to go past the 100 mil revenue range to allow for them to start saying, okay, it's more efficient for us to get to the next level through M&A. And maybe the SMEs can help with that, potentially. So we're doing an accelerator program with Meta to help SMEs figure out, okay, how do they scale better, right? And maybe through introducing better tech to SMEs, they can then say, let's start getting into the M&A game a bit more.
Yeah. I think the crux of it is that people find it harder in the Southeast Asia market than the US market, which I love that insight there, which is I think the US market was like, okay, there's a problem. And then the problem is, I don't know, I'm just talking out about like Pinterest, I guess. Yeah. I find it hard to put my images into an image board. And then for the US as a market, a starting market, it's rich enough, it's big enough, that if you just solve that problem, it's actually huge enough to be like, yeah, I can probably go for $100 million.
And you can build a business around it.
Build a business, right? But in Southeast Asia, if you have to do that, then sure, Singapore as the starting market for, let's say, 3 million actual users is an easy way to start. But then you run into this kind of blender called regional expansion, where the GDP per capita of Indonesia is 10x lower than Singapore, right? Or Malaysia 5 times lower. And then the market size, different culture, different languages, different regulations. So I agree that all these companies that we talked about, that were the heroes of the day, right? Because in our day, who were the heroes at our early days? It was like, we had Grab, Gojek as well. I think it's a good example.
Gojek, PetSnap.
Still
is a strong
as well,
company.
strong company. But I think there's a lot of companies that just, those that were like much more US indexed or moved to the US as well, continue that US, trajectory of, okay, just keep doing one thing but valuable, and we'll scale out through the US and therefore globally from there. Versus those that were more geographically bound. I'll give you an example, be like recently the Gojek co-founder came out and said, hey, we're too focused on Indonesia only. We should have done Singapore, right?
Yeah.
And technically, if we had a time machine, probably that would have been a question that would have come up in year one of those two companies. But again, both of them was like, let's solve the transportation problem. Let's just solve for the markets we understand the best.
Yeah.
Because the Indonesian founders were Indonesian. The Malaysian founders also understood Malaysia and Singapore. So to them, it was just like the first base. And they're both Harvard MBAs as well. So anyway, I just feel like now everybody is getting asked at a very early stage, right? Hey, you're a pre-seed founder. Here for my angel check. Which geographies are going to do? Don't you know it's very hard to scale? Like you get all these business questions that you and I never got back years ago, right?
Yeah. And to be fair, people have learned from their mistakes also, right? They've learned that a lot of founders say that they're going to do a lot of things, or that the hypothesis they have about the market doesn't always pan out because it's not very well thought out from the start. A lot of founders were more product or tech centric. If you want to build a Pinterest, right, don't build it out from here.
Right.
The truth of the matter is that you do need to be in an environment or an ecosystem where the support network, the ideas, the talent has experience, knowledge, and even interest building a company like that.
Right.
If Pinterest is built out of here, the likelihood of success would probably be way lower versus a Pinterest being built out of the US.
Yeah.
Fun fact, one of the early engineers at Pinterest was a guy that was, I think, Singaporean or based in Singapore for a very long time and grew up here, right? Sahil, who started Gumroad eventually. So that's problem number one, right? The kind of company you do, I think to some level, geography matters. Large consumers type companies, India, China, US. But there are also niche opportunities in B2B, whether it's agri, logistics, fintech, that you can capitalize on in this part of the world, right? MiG-33 is a good example of a company that started from the US, identified amazing opportunities in the feature phone space, and then decided to move completely to Indonesia. They couldn't make the jump to smartphones, and that's what led them to not be around today. But that's a really interesting example of focus on the ideas or the opportunities that make sense in the part of the world that you're operating in. And that's why we get compared a lot with South America. If you speak to LPs today that are US-based or more global, the immediate comparison is that, so your market looks very similar to LATAM, but LATAM seems to be doing way better than Southeast Asia. So why should I then invest in a fund that's Southeast Asia focused? I might as well just do LATAM. And it's a very valid question. There's the Carousell equivalent in LATAM. There's the Grab equivalent and all of that. And all of them seem to be doing a lot better. What is it about those markets that are doing better? A lot of it fundamentally boils down to GDP. Right. The GDP's numbers that we've been talking about in Indonesia just haven't panned out. But then you've got situations where founders realize that, hey, maybe the middle market is not the one that's going to go well. Let me go for the next lower market. And that's how you get Kopi Kenangan, right? They said, let's go mass market in Indonesia. There's a propensity to pay a bit more, and I can offer a product or service and go after that market. So that's where I think there has to be a tweak or rethinking or what kind of companies can do well here and then build business around that. Now, if you do launch a business here and then you realize the market isn't willing to pay or the market is too small, then get out. And Maito did that really well. Right? We saw Maito early on. I think the struggle again we were also thinking is how big's the market. Maito figured out, the market isn't that big. Moved to the US. I think they seem to be doing really well, opening up all over the US. And I think that was a very smart thing to do, right? I would have never believed that they could do it. And 10 years ago, so any founder that said they could do that, you would immediately write them off, right? But in today's world, I think that's definitely a lot more doable. I think what we're starting to see now is there are a newer breed of Southeast Asian founders that have realized, forget this market, let me focus on the US market. Let me either build a team there or restructure my products and services to cater to that market better. And they seem to be doing a much better job this time than last time.
Yeah, I think there's actually a really big difference, super fair, which is that 10 years ago, nobody was like, I want to build from Singapore or Southeast Asia for the US market. Didn't exist. Everybody was like, I want to solve the problem for my auntie who has this problem in this country. Therefore, it's a big problem. But yeah, definitely, I think you see a big And I call it the corridor, right? So it's a corridor between the Singapore and the US. I wouldn't say it's really necessary like Malaysia to the US or Indonesia to the US, but more of a Singapore to US corridor where Singaporean founders are trying to tackle that. I think we also see that for Castlery. We also saw that for PetSnap as well.
Yeah.
Okay, I think there's a lot of founders that made that.
PetSnap did China first,
Yeah.
Europe, and then US has now come in much later.
Yeah.
There are a lot of missteps along the way for that market. But for them, again, very deep tech product.
Yeah.
So the need to have a US team, a US base, and for Jeff himself to be based there was quite critical.
Yeah.
A lot of companies don't need to do that. Actually, to be fair, right, Pictochart, Malaysia-based company, for the longest time, they were fairly global, right?
Right.
And they did a good job serving a global market. But with Canva rising and all that has been tricky. Web3 companies on the flip side have seemed to have less of a problem. What is that company in Malaysia that has served the Web3 market really well from a content, media, and insight side? When it comes to me, I'll bring it up again. But there are multiple Web3 companies based out of this part of the world that are doing really well globally. And that's something to think about, right? What did they get? Was it a product standpoint, or was it the fact that Web3 in nature seems to favor Asian companies a bit better? Was it regulation-related issues, which is why US companies couldn't build in that space quickly enough, right?
Yeah, I think that's totally fair, and I think the answer is exactly, I think the regulatory side. America was very anti-crypto, a lot of China as well. Only until the recent Trump administration has there been a shift, right? And so I think people just had to build outside of America. So there's a lot of American expatriates or diaspora. Or they're working in kind of a global decentralized networks. So from their perspective, if they're working with a Filipino, for example, at YGG, right? There's a Filipino working, like everybody's just so flat.
Yeah.
And it's quite fair, right? Because in some ways, today I'm closer to some of my American friends than to my Singaporean Asian friends, because it's just more like we're the same vertical, same conversation, and we're just messaging each other. We can stay more in touch than somebody who's physically closer,
Correct.
right? And also, Web3 also came into existence roughly during the COVID era as well, the whole vertical. So the whole norms of it, everybody will be like, can you imagine a Web3 company says, we believe that everybody's on site in the office 5 days a week?
Yeah.
Doesn't exist.
Yeah, it doesn't make sense. Culturally, it doesn't work for them.
It's just, everybody will just laugh you out. It's just like not even.
It's like centralized manpower, right?
And we'll pay you in your local currency through your normal bank account.
Fiat, yeah.
Fiat. Everyone will be like, what kind of scam Web3 company is this? Right?
The funny thing is, anyone that actually took or didn't take fiat, I would assume a lot of Web3 guys do that, right? But anyone that then didn't do that in the 2017, 2018 would be sitting on a pile of assets right now that would have made them extremely rich, way more than any ESOP in any startup in the Web2 side.
Yeah, exactly. And I think that's a fair piece, right? So to some extent, I think we also see that a little bit in the AI side as well. I think AI companies are starting to blend a little bit, which is, I think they're just so hungry for talent. They just don't care where you are.
Yeah.
And startup side, it's like, can you do the coding?
I think for talent, right, it's a mixed bag. On some level, the teams that require collaboration, I think the realization is that they really do need to be in the same space. But for a lot of work that doesn't require collaboration, whether it's back office, whether it's content creation, whether it's marketing services, where it's really more access to a certain type of talent, creative, good at English, and then fast, being able to create content or data quickly, right? And then have good access to skill sets in AI. I think those can be all done remotely. So I think it's not, I don't think it's fully true that 100% remote is a good thing or 100% in office is good. What the world is realizing is that you need a healthy hybrid level, and some part of the work can or needs to be done physically, but a lot of it remote is totally fine.
Yeah. And I think it's interesting because I think you see the stiffening of that camps, because I feel like the big companies that would just never could do hybrid or remote, but they had to do this because of COVID. Now it's just a bit like, we're going back 100% return to office, which is, I think, a good choice actually in some ways, because it's just saying, hey, we acknowledge our hierarchy and culture, and the way we hire, this doesn't allow us to do that. I mean, like, our company is not interested in, we can't pay enough to force people to be really interested and be trusted to work well.
But I think on some level, there are probably enough bad apples that have not performed as well.
Yeah.
It's the same thing with employee benefits, right? In the past, the amount of employee benefits in the Googles and the Metas of the world was ridiculous. And a lot of that has been rolled back in the last 5 years, right?
Yeah.
As the push to profitability or the push to better unit economics has been key, right? So to me, the work from home thing is also a privilege. And now that it's been taken back, people are starting to see, oh no, it was a right that I had all along. And I think that there's some reframing that needs to be done, right? The other thing is this also. Some companies, like for example, mine, we are fully supportive of work from home, and we give the responsibility and onus to the employee to figure out which model makes sense. And interestingly, more and more people want to come to the office. That healthy delineation between work and home is something a lot of people are realizing, right? Unless you're someone that really needs to be home for a specific reason, or maybe you stay in an area where a good co-working space is not accessible, or you build a nice little home office like what you have over here, right? I think that it makes sense. I think giving people the choice is what is important, but for larger companies, it's very hard to do.
So that brings up the question of how founders are changing. What's the style of founders change between 10 years ago? So I think for me, one big change very quickly would be like, I think there was a lot of like university students, all of us were actually It's like, let's just build this and then just run straight into whatever problem that we see. And then there was no such thing as a professional tech executive or professional tech founder, like serial founder. Whereas I think today, there's a lot of like serial founders or like much more like sober, mature. They've done one or two gigs already. So there's more like a cadre of folks that understand the game and the mechanics. How about you? What do you think are the differences?
So there are a few that I see that are interesting, right? So there was a company I was tracking, solid tier 1 founder. And I just saw recently that he had left the company and joined a big company as a head of AI or something like that. So I called up someone who knows him really well. I said, hey, so what happened? He said, the founder realized that he could build the business to maybe a 50, 100K MRR. And beyond that, it would be really difficult. So he decided it's not worth his time and effort. And I think that's brilliant, though. I think that one change is something that a lot of Silicon Valley guys do really well. If they know that the business cannot scale any further, they'll either completely pivot, shut it down, or sell it in an acqui-hire model, and then get back to doing something else more productive. I think that trend is something I would love to see a lot more. Second thing is that I don't see this enough. I've seen this only a few, and I think I've talked about this briefly, right? Finding a better blend between new money and secondary. This mindset of early stage investors exiting at the maybe A and B round, and that being a negative signal, really has to change. Right? Need to drive liquidity for early investors it should be a deliberate effort at every stage through secondaries from the new money that's coming in, right? And the logic is that you should be allowing early investors to exit. If they want to continue on the ride, let them reinvest in the current round, right? But providing liquidity in the ecosystem, it's an important, necessary thing. You talk to most LPs now, the number one gripe is no liquidity in the ecosystem, right? The third thing is, I think, if you talk to founders now, most of them have a much clearer idea of what their customers want or don't want. And whatever they're building for seems to have very clear 6 to 12 month clarity on the product market fit. They might not have built it yet, but they know, okay, I've spoken to these 20 customers. This is exactly what they want. This is what they're willing to pay for. Previously, it was always, I'll build first, I'll go to customers later on. And I think that switch has been healthy. Those are just some of the things I feel has changed quite a bit.
I think another difference has been the regionalization of the founders from 10 years ago. I think 10 years ago, a lot of the founders primarily Singaporean or like sea turtles, people heading from America to Southeast Asia. And I think now you see a lot more local kind of founders in Vietnam, Indonesia, Malaysia as well. So I think that's one trend. Another trend I think I see is that in the past, it was always about Singapore as the place to meet and get there. I think that is decentralized, whereas almost like different clusters where each country, their clusters know each other. And then there are some like regional connective tissue, either because people travel a lot or because the companies are in both markets or they're VCs who have that mandate. I think the VCs are much more connected in the same, I'll say it's much tighter than Singapore as a hub because of your fund administration, because you got to fundraise from LPs, because of all the various conversations they have with your American or Chinese counterparts. But I would say there's an interesting change as well.
There's also less of a desire for founders to be based exclusively in Singapore, right? If you look at the ecosystems regionally, like Malaysia is coming up extremely well. So a lot of founders are also, because of the cost base, right, are much more open to basing themselves full-time in Malaysia, which I think is a great thing. Philippines is also coming up quite a bit. So a lot of founders figured, hey, why not just base ourselves there or go there more often? So I think Singapore might not be the number one choice for where you base yourself physically. Your company will always be headquartered here. Where you base yourself physically might not be there. But capital raising, Singapore will always have that number one choice. I think more so now, even considering all the issues in Indonesia, because I think there's still a better respect for the rules of law and the rigidity on DD here. What I think will change over time is that founders are definitely, like we mentioned earlier, more open to non-Southeast Asia markets. At some point, if Southeast Asia doesn't work, they'll start looking at markets like Australia, US, Europe. So I've seen some founders here get some decent product market fit here, but realize markets like Europe makes more sense. Tesseract, for example, in the legal tech space, Mito in the health tech space, DCube in Malaysia in the AI tooling. I think that one is great. Opening themselves up to global markets is something they should do faster. Second thing is the ability to pivot faster. We had a conversation with the founder yesterday where if you realize the sales cycles are taking too long or the segment that you have cannot move quickly enough, how do you pivot quickly enough to complementary segments where ideally maybe their AOVs might be a bit lower, but the sales cycle might be faster. So that faster, quicker pivoting capability is, I think, something that still needs to be done a bit better in this region.
Yeah. I think it's interesting because another piece that reminded me of is that the regulatory interaction is much more visible to founders today compared to 10 years ago. Because 10 years ago, it was just like, oh, it's inefficient and it's bad. Therefore, I'm just going to solve it. And then they build a product and then they work out the business model along the way. And then after that, they talk to regulators later. Whereas now, I think there's much more sensitivity, especially in Vietnam or Indonesia. And Gita Sa here, a co-host, shared in the previous episode. She said, like, if there's friction, somebody's benefiting from the friction today, right? And therefore, you need to understand what are their incentives, but also how they're going to push back against you if you remove that inefficiency. And therefore, I think a lot more thinking about the stakeholder management in Indonesia is actually very key, right? So I think now you see some founders who are basically piecing out from Indonesia because they're just like, I don't want to handle the stakeholder management. I just want to handle the government and the various trade-offs or sacrifices that I make. I'm just going to piece out and like build for America where I build a SaaS business or whatever. So I think I've seen quite a few founders.
The other thing is also that realization is, hey, you can keep trying to bang your head on the wall. If it's not going to collapse, then just leave, right? And I think like your more traditional industries like your agri, your supply chain, the founders who have not found ways to better integrate locally as opposed to completely disrupt, they are the ones that are completely not surviving.
Yeah, that's true. I think the ones we've seen is that those who take a more of a disruptive American approach, these people are horribly inefficient, we're just going to disrupt them and kill them, they have definitely suffered more. Because I think the incumbents in emerging markets have more ability to push back in a non-economic way. They don't have to compete.
I think the world underappreciates the amount of loyalty everyone has towards existing system because their livelihoods are also challenged. But on some level, the larger conglomerates of the families control so much that it's actually not worth the effort to try to disrupt yourself. So I think for the traditional non-tech folks, disruption is not a good thing, but healthy evolution to make things better or to make their lives more efficient, that is something that can be thought about. And that's what I think a good example will be Basket, right? I think Basket is doing that really well in Indonesia with supply chain.
Yeah, because I think they're much more like peaceful. Willing to split the rewards, which makes it harder for them because there's less margin. Because you have to split it people. But then at least when you do it that way, your margin is sustainable. You're not going to have somebody kicking at your legs.
But then over time, you can find maybe new inefficiencies or new opportunities in the systems that no one is looking at and then build for that.
I think that reminds me actually another thing is what makes the incumbent so difficult to disrupt versus I think how the market is evolving that. I think a lot of people tend to think about these family-run conglomerates or businesses as a single product, right? Okay, this is a bad experience, therefore this is bad. But actually, if you look at the conglomerate, actually it's vertically integrated, right? And also horizontally integrated. But I think the vertical integration is actually the part that's really scary because they just make more money at every step, right? Which is like they make money at the basic materials inputs, they make money on the logistics, they make money on the trading and distribution. So take all those cuts and then each business is worse than a pure play, whatever. But then actually all these things can squeeze and actually compete. So I think there's a very tricky piece. Family-run conglomerates have internal pricing. So in other words, they can control the stakeholders in the system, right? Because every single person is reporting to the mothership. Versus here, if you're a single pure play, then you end up having to give a cut through a revenue share, whatever it is, to the layer above you and the layer below you. And that can be actually quite extractive, right? And so I think that makes it very difficult to compete.
See, no company is going to cover everything. There are going to be market segments that they will ignore, or there are going to be verticals or areas where they feel that it is not large enough for them to bother. That's where I think there's an opportunity for startup. There's a piece I read where there were two companies, and then one of the companies received like $100 million investment. And the founder of the other company decided, rather than close and struggle from this competition, they should laser focus on a very particular segment. They were offering some kind of SaaS service, very particular segment, and build deep features and services in that particular segment. So if you look at Nexo, I think in Australia, right, CRM, for example, is already a big market, right? What they did extremely well is laser focus on the legal industry and laser focus on the industry where it's more services driven. And then they built all sorts of features and tools that was extremely valuable to that segment. I think in Southeast Asia, there's a tremendous amount of opportunity to look at opportunities like that. Are there areas, for example, let's say in Malaysia, right? My own father-in-law is a fintech founder, right? There are opportunities, for example, in just fuel fleet management that you can build a very sizable business on that very few people or practically no one is looking at, simply because they think the market is too small. And I think Indonesia has a lot of opportunities there that founders can think about. And what then needs to be done is raise less capital, do smaller seed rounds, raise less capital, you get to profitability much faster. Then use profitability to then scale to adjacent verticals.
Yeah. And I think actually the response by the founder side is that they are becoming vertically integrated as well, or horizontally integrated to build out synergies from their perspective. So I think they look at these businesses and they're like, so their reaction to also what we just talked about earlier about whether the product or market is big enough is now they're saying like stuff like, I really shared a founder for me, he said, Jeremy, I just want to be aggregator of boring businesses in this vertical. So each business is $100 million, maybe top. But then because they have the same cost base on the technical side, same competency on the vertical. And then my perspective was like, okay, before you go too fast horizontally, like maybe focus more on the vertical integration because it's a little bit easier to build a product before you jump to a new vertical, even though it's adjacent. So I think that's been, one big push. And I think that's why also I think people are so excited by the eFishery story because it felt like, and it clicked for a lot of people in the agri-tech space, which was like, okay, you know what? They're solving for the wastage between, let's say, vegetables at a farm to the city is not enough money. But if we can do end-to-end, then, it becomes a mini agricultural conglomerate that's vertically integrated the entire, supply chain. And then you make enough money from each stage. And then each part also makes it a little bit easier to compete. And then maybe potentially in the future, you can expand to new geographies for the same play. So I think people were very excited, remember, about the eFishery. And then I think Indonesia, remember you and I were debating all the time. And, and I was kept saying that. So literally the founders will say, we are the eFishery for X, which is implied horizontal geography across Indonesia in terms of islands, vertical integration of the margin,
all the different layers within,
increase productivity, reduce waste. Those are the code. And then, of course, we're going to make a lot of money like eFishery. So those are the code words, right?
So, okay, fraud aside, right, if we took a step back on eFishery, instead of making it a crazy venture backable business and raising all that money, could eFishery have been a really good, maybe $20 million top line business that was extremely profitable? And I think that's probably not the mistake, but something that the founder should have thought differently about. Rather than raise all that capital, change the model, make it extremely profitable, super tight in that aqua niche, then raise capital for vertical expansion. He could have applied these opportunities to poultry, cattle, or many other sectors, right? I think that's where he got caught up, raising too much capital and then inflating all that numbers. Because he really just needed to justify that the aquaculture vertical was massive enough and money just could be poured in to support that vertical, which probably was never the case.
Yeah, and I think that's what we saw when you dig deeper into the kind of like the audit findings was like burning over $100 million into trying to boost that. And what's interesting is that actually, if we look at it, the leakages were not leakages out of the company, right? So it was actually burned on trying to expand the company, but it just couldn't make the top line growth. So they inflated the revenue. Because it's different because if the money went to somebody's pocket, the vast majority of it is very different. But actually, the vast majority is being spent on trying to boost, but I think they hit some kind of like plateau on their growth where the more money they threw in, the growth didn't show up. And so they were just digging themselves deeper and deeper in the hole. Okay, I inflated my revenue. I'm just going to throw in more money to catch up that growth. It doesn't pan out because the marginal return of that dollar is less. Because I think the market's saturated. And so I think one thing I often think about it, I've also talked to a lot of the founders who have, and we've talked about it even before the eFishery blew up, was like I said, I think they should just try to list on the IDX, on the stock exchange, which is obviously the valuation multiple is very low. It's like very 1-for-1 for every EBITDA. But I think you can make the case like at least it's a sure path for a liquidity event. And then you drew a capital efficiency, and then you can exit about 100 million valuation. I think there's a path to get there. You just focus on the capital efficiency.
They should have just built a $20-30 million top line business, really nicely profitable, and then expanded across other verticals through VC money if it made sense.
And they could have bought out all the adjacent agri-tech. There's actually another talk about it. Super fair.
They could have done an M&A play, right? They could have raised capital to buy out equivalents of theirs in adjacent verticals and then use their expertise to help them scale.
Correct. So there's shrimp farming, there's rice farming. And also the agriculture areas have...
Within agri alone, they could have maybe deeply specialized in salmon or certain breeds of types, right? Shrimp is another one that you mentioned really well. But if we take parallels and learnings from Grab started as Grab Car. It started My Taxi first, right? Then they started as Grab Car. And then they did the massive rebranding to be Grab. And then they went into all sorts of different verticals themselves. So they were able to raise that capital, but also go into adjacent verticals that made sense to their primary vertical at the start, which was transport. So to me, they were a good example of an organization that was able to scale in a reasonable manner across different verticals. And now, of course, they're in fintech, they're in delivery from like packaging and everything else. There's still some time for them to prove that they can be profitable. I think it's still promising, but great example of a company that had raised capital in the correct manner and expanded vertically that way. I think that's the missed opportunity for eFishery.
And I think the worst part about accounting fraud, I think people forget about this, is that when you build the metrics wrongly, you end up telling the story wrongly to your investor. And then you think to yourself like, oh, I can keep my story straight. But actually it's not, because when you tell the story to your investors, it breaks your own internal story to yourself and your employees, because those stories can be quite similar actually. And then you never end up making the strategic decision about, they call it come to Jesus moment. Like they don't have that revelation to be like, this isn't working, or this market's so small. And it's not your fault. It's okay. It's okay. What? The fact that they built out quite a sizable business in fishery was actually quite positive. If you look at the numbers, you're like, that's actually a pretty healthy number, healthy bucket.
Evo did the same thing, right? Roy did the same thing with Bounce Back, right? He got it to a level and then realized that, okay, to get to the next level, even the market's too small, the capital requirement for that is too much. And then he launched Strive through his learnings with his own investors, right? That actually the electronics vertical has a lot more room to grow. The market's a lot bigger. Launched Strive, and that's now a bigger business than Bounce Back.
Yeah, so there's a horizontal integration play because they're using the same internal capability of marketing and
brand building,
brand product market fit, distribution.
Plus, they already had the distribution network with the influencers. Plus, the original network that they had, that they were selling the hangover pills to, they were very complementary to selling these new electronics and products.
Yeah, and if you think about it, for example, eFishery had this massive amount of fraud on fish feeders. Right? So just like probably like 90% of fish feeders were fraudulent. But if you think about it, if you made just 10% fish feeders and then you make feeders for chicken, and there's everything else, there's all kinds of productivity devices like IoT, whatever you call it, and you just build out a competence. There's more than 20 types of agricultural products. They didn't need to conduct that fraud if they just said, okay, the key insight here is we're just going to do it, make it a little bit easier for farmers to feed their fish on time or the animals on time. That's all they had to do, right?
See, this is where sometimes I wonder if there was a private equity investor running eFishery, how could they have changed the outcome in a way, right? Because we all know PE firms are a bit more profit-driven. They really like to cut out all the fat to maximize the profitability. And they're perfectly fine having lower top-line numbers, but very good EBITDA and net margin numbers. So that actually could have been interesting if a PE firm actually bought the business or was able to turn that around.
Yeah, you can imagine a situation where somebody bought and consolidated all of them, right? So you have, I think, eFishery, let's just say, Delos does shrimp. Then you can add Iratani for rice. You can add Broiler X for chicken. I'm just an example, right? Then a lot of them are quite Indonesia focused as well. Then you add Aeonic, which is the agricultural drone
for the drone stuff
from Malaysia. And you're like, wait a moment, this business is pretty good because basically you're saying like for any kind of Southeast Asian crop, we have a fleet of mobile field officers that can handle different whatever it is. And then you have a drone company to help with your spraying or pesticides or fertilizer. Then the stack gets quite interesting. And I think that's where I see some founders starting to think about it, but they don't have the private equity muscle. So I think what's interesting is that you see the founders speculate a bit about it, but I think they struggle because the founders don't want to exit because they're still going for the VC path. So they don't want to sell at a certain multiple. Or they raise so much money at a VC multiple.
Not just that. They start to realize the PE multiples are nowhere near bullshit multiples that the VCs give them. What we have learned is that on the IDX level, a lot of businesses are valued at 1x revenue. And most VC funded businesses at the early stages end up growing towards PE type business, where at the max they can get maybe 2x, 3x of revenue. And so for most founders, I think the bubble is burst in terms of their own net value in the organization. The moment they realize that 20x of a net margin is considered very generous, and considering the small net margins they make already, it's too much of a reality shock, which is why I think they rather than just go down the VC path, push for the high growth number thing.
Yeah, and I think that's a tricky part, right? Because the reason why the VCs are doing a lot of the early stage capital is because they're the only one in the frontier markets. They took the country risk. But then the reward profile that had been promised was, like you said, like a 25% net IRR. Then what that boils down to is, the valuation multiple they're giving is 10 or 20x revenue multiple. So now you have this mismatch where like imagine theoretically there is a roll-up private equity play across, let's say, this agri space. This is brainstorming here, right? Yeah. But then everybody, their private investors made the decision to make a 20x. And maybe over the past year, they doubled the revenue, so still only a 10x multiple. But then if you want to do a private equity roll-up, you're going to offer them what? A 1x?
Yeah, exactly.
2x?
That's the problem.
And then suddenly, like the VC on the board is like, yeah, why am I going to sell and take an 80% haircut on the valuation of this company just so that you can be part of a private equity roll-up? And I should be the one doing it. Right? I should be the one acquiring you.
I should use the paper valuation to raise my next fund.
Oh yeah, exactly. Right?
And then continue kicking the can down the road. And that's the problem. That's essentially the issue with the whole industry. Right? Nobody's driving the exits because they're starting to realize, or the sky's now falling, right? Because they're starting to realize that actual values of what they have is nowhere near the VC value.
Yeah. And I think I previously shared my thesis as well for SaaS, right? So there's a lot of HR and CRM, SaaS tools. They're actually very adjacent to each other. And maybe the market size for each one is only 10 million in Southeast Asia. But if you handle unreached excess, then you do payroll, then you do payday lending. And then each one is like $10 million of revenue. If you think about it, people are trying to do like gamification, employee gamification. And you're like, okay, as a standalone business, is it big enough for Southeast Asia? No. But can you imagine there's maybe $10 million of revenue across Southeast Asia for the right people who want to do it? Yeah, you can do it. And then you just have, imagine this monstrous one-stop HR solution. For each item and module that we have, our job is to be 90% of what the Americans do. You know, they say, whatever the American does, our job is to be 90%. And then they do the product market fit, they do the design, the UX. Our job is just to be an efficient clone and clone 90% of functionality. But more importantly, it works across the region. Then each piece is $10 million revenue. Yeah, there's more than 20 HR modules and company modules. But the problem is that, again, each of these SaaS modules in Southeast Asia were valued at 20x, 30x.
Yeah, the 20 mil valuation, the entry price, right?
Yeah, exactly. Typically,
that's what they would all go to.
So it's like people are just talking to each other and you're like, yeah, but if you can imagine, if you put everything together, it's actually a very big business. And I think it'd be a very profitable business.
Which is the big issue why the exits on the corporate sides also have not happened. If you talk to any conglomerate and if they see, let's say they see a startup doing 10 mil in revenue, 1 mil in net margin, they're not going to pay more than 10, 12 mil.
Yeah, right? M&A side as well.
They will not.
Yeah, because who's my competitor?
They can't make the capital back as well. It'll take them 10 years just to make that capital back. That's problem number one. Problem number two is that this guy probably raised his seed round at 12 mil valuation. He probably raised his A round at a 35 mil valuation. Now he has to go back to all his VCs saying, hey, I'm going to sell the company for 10 mil. And everybody's going to lose. And then he probably has anti-dilution clauses in there. So he's going to lose even more. So what happens then?
Yeah. But what I would, as a founder, it's a very bitter pill to have to swallow, right? Let alone for the VCs who are like there, right? So I think the reason why we're talking about this is just a call to action. I think we just have to be rational about the end state of these things. Otherwise, you just see a lot of people like repeating stories on conference panels and speakers, and they're talking such a big game.
What if every VC pivoted to be a PE company and they changed everything to operate with a PE mindset?
If you're assuming that the LPs agree.
Let's assume LPs agree, right?
Assuming everybody's egos are okay.
If you tell the LP, like the likelihood of me losing your money is 90%, but the likelihood of me giving a 10x with that. So if I could either lose all your money with the investments I'm doing, or I could potentially give you back 3x, but operate in a PE kind of style.
Yeah, right? I think first of all I think that your multiples will drop by about 10x. Now, it may not show up in price, but it may show up in control rights as well, which is like a lot more board seats, a lot more retrieval.
More hands-on, right?
More hands-on. So I think the overall package, the multiple will drop by about 10x. Maybe the price on it drops 5x. The other 2x come from control rights.
You were at Monk Hill, right? Imagine Monk Hill Ventures, right? Suddenly pivoted their whole model and said, okay, we'll be hands-on. We'll be PE style investor. And from now on, we'll take more majority stakes in companies. We'll operate. Maybe we'll bring in new management as well. Do you think that will help? Looking at, let's say, Monk Hill's portfolio in the past, or maybe some of the deals that they've done.
I think that the talent does exist in Southeast Asia, and that kind of talent that's willing to go hands-on doesn't get enough opportunities to do that. So what I mean by that is, I think we see a lot of really good general managers in Singapore, I would say, but also in Southeast Asia, who are running family conglomerate. And they run a business very well. Let's be super real. They control everything. They know how to manage their stakeholders, like the government or the levels or whatever it is. They focus on profitability. They know their books. They're very good. It's just that they're stuck to a family for their whole career.
And they wouldn't want to leave their family to risk it too.
Yeah, but I'm just saying there's also a lot of people who are non-family executives reporting to a family that are just like in that structure. So it's a lifetime role. But I think there's a lot of great talent that you can imagine that if you talk about that fishery roll-up or consolidation. Are there agri executives across the various conglomerates in Indonesia that are known to be hungry, get shit done, and take no nonsense? Yeah, duh. But it's just that they are in one conglomerate and they can't move to another conglomerate. So I think private equity fund that has that strong agri business could be like, okay, I'm going to take you out. You go do a 4-year stint, clean up this thing. Like, I think the talent does exist, but they just can't get out. And so I think one benefit of private equity play is the marriage of two things, right? You know what I mean? Because on the VC side, it's very much like our job is to identify the best founders, because no matter what, we want them to be founder-led to some extent, and we're very hands-off on the support. And then now it's the other way around, right? I think we see private equity funds, and like that now to some extent, like such funds are happening now, which is micro PE, which is they raise some money, 10, 20, 30 mil. But then, of course, it's the same person, like it's a one-person job, where that one person is basically supposed to be raising 10, 20, 30 mil, and they are also going to run the business. And so this combination is pretty rare, actually.
But this is still in the very early side, right?
No, they're buying family businesses, right? So those such funds are going to buy a second or third gen business that the kids want to run. So therefore, but of course, what I'm trying to say is that kind of talent is quite rare. The people who are good at operating find it difficult to raise 10.
So those are already businesses that are going fine. They have the profitability. They're not going to grow 5, 10x. And they have maybe older retiring founders or founders that don't want to do it anymore. Slightly different, right? What I'm saying is, what if a PE company went in and restructured Carousell to make it a super profitable machine? Would the investors be okay with that? But Carousell is not going to get the $1 billion or even the $800 million valuation they have now. It might scale down to 200.
Correct.
Because now, if say Carousell gets to a 10 mil net margin level, right, 20x of that would be a fair valuation.
Yeah, you're effectively arguing for like an Elon Musk takeover of Twitter, right? Where I mean, I'm just saying, like Elon Musk fired 80% of the workforce. Unfortunately, when he did that, revenue also disappeared by about 80%. So he ended up in the same net position.
X is not a great example, right? But let's look at EQT, a lot of these firms, right? We need a mini EQT equivalent for this region.
Yeah, so I think the problem is that we have micro, we have small, we have medium, and we have large. And for large private equity funds, there's just not enough targets in Southeast Asia. And there are too much political and government control, if that makes sense, to ever allow those acquisitions to really happen at a fundamental level.
But fundamentally, it's just not enough.
Yeah, and then the micro is your search funds, which are starting to emerge, and I think they're getting quite hot. But of course, there's some struggles, and we can talk about it later. Obviously, they have their own struggles because the issue is that you're small and medium, and if you look at the US, the issue is that the micros will normally sell to the small PE, and the small PE will sell to the
larger ones.
And then the medium ones will sell to the large PE funds. So to some extent, it's like the VC ecosystem, the same thing, which is there's still an end game of a public IPO market exit. And it's a bit of a chicken egg dynamic where if you had this anchor at the end, then the value flows. So you see a lot of the search fund folks in America, for my friends who are running search funds, their job, they don't want to run a tire repair shop forever. Their job is they want to buy one, make efficiency, buy 10, 20, 50, 100. But then after that, they want to sell to the small ones. The small ones sell to the medium one, the medium sell. So to them, actually,
but they can only do that because at the start, there's already capital efficiency, there's already sustainable unit economics, and there's profitability.
Yeah, so the question now is, what's the incentive for a medium-sized PE, for example, to buy a tech business like whatever it is, to buy over, like what's the end game for them, right? Because is it going to be a local listing that has a low multiple? Then people are like, is it really worth my while to do that, right? Versus everything else in life that they can go after.
So EQT buying Property Guru, for example, right? Do you think the end goal is for them to relist Property Guru?
I have no idea.
No, but so that's the thing. I'm thinking, actually, for most companies, the end game is not a public listing. I literally had another session with the founder, and he actually spoke to folks who had publicly listed companies. Having a public company is a shit job. It's so much better to be privately held within a PE firm and you use the profits to pay dividends. It's actually way more worth it long term.
No, I get it, because if you're a founder holding a private company and a management team, then you don't have to do the compliance side. But the crux of it is, what's the private equity incentive? And for the private equity funds that are the large to medium size, and this is where I think it goes back to it, is they just have a better return profile in the US. So I think that's the crux of it, right? Is that I think if the US market was not so compelling because of their relatively low interest rates, because of, I think, the government tax subsidies that make it better for private equity funds to operate versus, I think, other forms of corporate instrumentation. Then for a private equity fund, then it's just like, wait, these are all the benefits that gives us a better target list that's a lot more deeper and a lot wider to go after in the US market compared to doing it in Southeast Asia. You get me? So I think that's where there's a little bit of like chicken and egg problem
The
we have.
end issue of a capital listing in this part of the world or in Southeast Asia is something that I really cannot foresee that getting fixed anytime soon. Because there's no real effort to even fixing it.
I think we see, I would say, small and maybe medium private equity plays in healthcare. So I think we do see that.
Yeah, but as in for the end game to get them listed, right? You're saying that for the latest stage private equity firm, for them to get incentivized to do all the deals, there has to be still an exit scenario where it goes to a listing.
For example, And I think that's in the US, that pathway, right?
But in this part of the world, that pathway just doesn't exist. Could Japan fix the gap? Maybe. Australia, it doesn't seem like they'll do that very much for Asian companies. I think they're a bit more US-centric. Could India do that on some level? I think it still take a long time. They're going to favor their own companies for the longest time. China, I think nobody would want to do that, even if the option was there, right? So the truth of the matter is that in Southeast Asia, I think private is a game to go for a while.
So I think that it goes back to it is just private equity and venture capital are both forms of capital to support growth. And what it boils down to is the quality of the founder and the management team to be capital efficient. Because like the private equity and VC game is this, if the reward profile is there, I think where the region is ill-served is when we go to a big conference and everybody's like, these are returns that are possible. And then the founders are like, okay, I'm going to go for that growth strategy to match the VC profile. And then, but they keep the game on. And then, it just feeds this very echo chamber illusion that has been slowly collapsing over the past few years. And then it doesn't allow early stage founders to be like, we start this being disciplined earlier, to be more capital efficient earlier, to create a set of reward profiles that can work with private equity or more like capital efficient venture capital. And vice versa is only by doing this group of founders coming in, can these people come in and start pitching the LPs that, okay, actually we have founders that are quite capital efficient and willing to roll up or consolidate. So it's a bit of a chicken and egg at this level because this game is so good, right?
So the tricky balance is then for the VCs at the early stages, they have to start getting a lot more pragmatic on the valuations they are giving founders at the early stages. Not to the level, right, where they start discouraging founders from raising capital early on. Right? Because if every VC starts to say, I'm only going to give you maybe at a seed round a $4 million valuation, then founders are just going to completely stop starting companies. They're just going to continue with their corporate job. So that balance has to be there, right? The VC cannot give too high of an early stage valuation because then they're disincentivizing founders to get to profitability quickly enough. So that's the first part of the problem. The second part of the problem is that growth stage capital needs to be less VC-centric, more PE-centric. So maybe even a Series A investor, from now on, maybe Series A investors should think less like VCs, more like PE management.
And I think that's where the VC funds are smaller, have to be therefore more hands-on versus the amount of check they bring in. Because obviously, if you're too tight, then founders are also like, why am I even taking this money as well? The funds in Southeast Asia become much more disciplined about the amount of value they bring. And it's always like that sliding scale, right? Which is maybe I bring a very large check, but then we're very hands-off, but then you have to pick very well. Or your check is small and your amount of help is obviously low, but it's not so low. So
maybe they start having a bit more accountability on the value.
So how much value? And I think we're going to see two bifurcation of that fund support. We either have partners who are just going to do all the support themselves because they understand the business, they are on the board to some extent, or they know the numbers and are very clear and laser focused about the VCs basically work harder than GP. But I think the other way that we're seeing it is the accelerator models, so your Antler, etc., where they just focus on very structured key pieces that they delegate. But like it's almost, again, it's not as good as the hands-on one, but it allows them to provide, even though they scale to 20 or 100 or 200 or 2,000 startups, the amount of value doesn't drop too low. And so it's still good ROI for the check. I think the thing that's going to die in between is like the in-betweeners. Is I don't help you at all effectively,
just purely
or I delegate it to a bunch of people who are not very motivated. And I think that's where also I think VCs will start to collaborate more with each other because it's okay, no VC can be good at hiring, marketing, support, strategies, and blah, blah, blah. Like, I think maybe more like syndicates where I think, I'm the same example, right? The VC is going to be like, okay, I'm really good at marketing, but I can't do anything else. And let me partner with somebody else who's really good at consumer, for example.
I'm just thinking the role of government here really could, rather than play matching fund role, where they provide, let's say, one-on-one matching based on capital raise. The role of government here is to provide that support the venture. To see the value of the funds that they provide to founders is only going to be a function of how much fees they can collect. So if you're starting a 20-30 mil fund, there's really very little hands-on support that you can provide to the founders because the fees are too low. The governments can come in and say, hey, look, if you have a 20 mil fund and if you have a very clear plan on how you're going to support founders, this is where we can provide support. So we're not providing matching on capital raising for you to invest more. We're providing support on your fees. So you can hire better folks to provide better support to founders.
I haven't thought through all of that. I would say that for government, theoretically, I think whatever you support will be supported and to do more of, right? It's just that obviously supporting financially is easier to audit and to deploy than to determine the value of value-added services of VC funders. So I think that's the tricky part of the audit side. So that's one. I would say that one thing I do think about is if VCs do a better job sharing and saying, okay, I want to get this allocation. But just taking a step back is, okay, but there's a gap in this company. Who are the 3 other VC partners I want to work with? And we're going to work together to make this company more successful together. And I think that's obviously a big coordination problem, I would say. But I think you can imagine that that could be a way to increase the value of that business, right? Yeah. Rather than trying to have to duplicate. Because I think all I was trying to say is like, you have solo GP funds, and a solo GP can only be good at one thing, which is the investing and also whatever skill set they have. So if 3 or 4 different solo GPs work together, I think they can do a better problem if they know and trust each other. On that note, I think we probably should wrap up here. But if there's one word of hope that you want to actualize or visualize for the year of 2025, what do you think is going to be?
Oh, for me, it's curiosity. So that comes from, I rewatched Ted Lasso. And one of my favorite quotes in the show is, be curious, not judgmental. So I think for this year at least, I'm always reminding myself to have a curious mindset. If something is new or interesting or different, right? Just have a more curious mindset to understand why and put in a bit more effort to be just less judgmental on things, but more open. So that keyword for me is curiosity.
Ah, that's beautiful. For me, I think the word would be equanimity. I know it's a very Zen word, complicated. It's like, how do I spell equanimity? But it's a nice word to say that when times are good, you're more calm, right? And when times are bad, you're also more calm. So you're not too swayed by the swings, right?
Yeah, very stoic in some sense.
Stoic to some extent. But we're in Asia, so who's Marcus Aurelius, Roman Emperor, Zen, right? Buddhism. But I think it's in every religious or cultural, spiritual tradition, there's always that piece of equanimity, which is that basically the saying is that I think right now, like when the bull market was happening, everybody is like drank way too much of the Kool-Aid and being super bullish. And then a lot of the people who did better ones were like, hold up, this is too good, right? Let me just take a deep breath, whatever it is. And now I think we're almost at the other end, which is I think we're so tired, exhausted from the winter for the past few years that people are just like cynical, and especially because of the scandals and all this stuff, because they're finally imploding. And so a lot of people are very like bearish, like will never work. And I'm like no, it's not that bad, but it's just that we have to be more sober about what it is. So to me, I think that's also the more centeredness.
We have to remind ourselves sometimes to have a bit more of a childlike fantasy view on startups, because at the end of the day, it is about solving problems differently. It is about creating solutions to or creating new ideas to issues that have existed for a while. So that healthy balance needs to be maintained.
Exactly. And I would say that right now, I think the sentiment is too bearish for the fundamental macroeconomic fundamentals of Southeast Asia. And it's good because we've got to discuss this stuff and be direct and honest with each other on this podcast. So that whoever listens to it is, okay, there's a different approach we can do. Because if not, there's not the massive multiple valuation game, blah, blah, blah. Every country in Southeast Asia, the same country, super easy to explain. Versus we should never do startups and I should just continue in academy. It's somewhere in between, right?
Corporate,
corporate, right? But I think you got to figure out the right niches. And I think there's also many good founders that we mentioned that figure it out. On that note, let's wrap it up and see you next time.
Yeah, thanks for having me.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.